If you're running a real estate syndication where more than 35% of your losses in any one year are shared with limited partners, you're going to be considered a tax shelter. And thanks to the new business interest limitations, that means that your mortgage interest deduction is going to be significantly limited. This creates a problem for syndicates of all sizes, especially for the deal sponsors that are unaware of these rules. The good news is there's a way out. I'm Brandon Hall, CEO of the Real Estate CPA, and in today's video, I'm going to discuss the business interest limitations and what you can do to avoid them. Before we get started, subscribe to our YouTube channel. You'll be notified of new content whenever it's released. And if you like what you're hearing, check us out on a virtual workshop at www.therealestatecpa.com/virtual-workshop. Tip number one, let's just understand what the business interest limitations are. If you are subject to the business interest limitations, you are only able to deduct business interest up to 30% of your EBITDA. That's earnings before interest, taxes, depreciation, and amortization. Basically your operating income. In 2021, that's going to move to 30% of your EBIT, so your earnings before interest and taxes. So for example, if your operating income, your EBITDA, is $100,000, you can only deduct $30,000 of mortgage interest, even if you have more in any given year. Now, in most cases, you don't have to worry about the business interest limitations because it's really reserved for businesses grossing more than $25 million a year. But if you're running a real estate syndication and you have passive losses and you distribute more than 35% of those passive losses to limited partners in any given year, you are running a tax shelter under IRC section 1256E3 cap B. And tax shelters are subject to the business interest limitations. If your syndication is going to be subject to the business interest limitations, comment below with yes. If not, comment no. This will help me create better content for you in the future. The second tip, and this is the good news, real property trades or businesses can elect out of the business interest limitations. But the bad news is that once you do elect out of the business interest limitations, you're no longer able to claim 100% bonus depreciation. You do have to depreciate over the generally less advantageous ADS depreciation system. And it's an irrevocable election, meaning that you really need to plan appropriately before making it. The third tip, which is really good news for syndicates, is that electing out of the business interest limitations does not preclude you from taking 100% bonus depreciation on 5, 7, and 15-year property. And I know I just said in tip 2 that if you elect out of the business interest limitations, you can't take 100% bonus depreciation, so let's explore that. Under IRC section 168G8, it basically says that 100% bonus depreciation, when you elect out of the business interest limitations, will not be allowed on non-residential real property, residential real property, and qualified improvement property. It does not make reference to 5, 7, and 15-year property, meaning that you can get a cost segregation study done in the first year, claim 100% bonus depreciation for 5, 7, and 15-year property, and elect out of the business interest limitations also in the first year. So really you get the maximum write-offs by electing out of the business interest limitations in the first year. The only downside is that now we depreciate our property. If it's a residential real property, we're going to depreciate it over 30 years versus 27 and a half years. But we're still going to be able to take 100% bonus depreciation on our 5, 7, and 15-year property thanks to our cost segregation study. This is really important for sponsors of syndications to understand. If you don't elect out of the business interest limitations in the first year, that's okay. You can still take 100% bonus depreciation from your cost segregation study. You'll just have a limited mortgage interest deduction. You could elect out of the business interest limitations after the first year, and that's okay too, depending on your plan. But when you do that, just know that there is no depreciation recapture on that 100% bonus depreciation because under Revenue Procedure 2019-8, they've deemed the election out to be a change in use, not a change in accounting, which is another rabbit hole that we're not going to go into today. But just understand that there is no depreciation recapture if you accidentally do not elect out of the business interest limitations in the first year and you elect out in year 2, 3, or another year. Thanks for watching. Make sure that you comment, like, subscribe to this content, share it with everybody that you know. I really appreciate it.